Another employee reward is employee incentives. Employee incentives are extra payments that are provided for extra performance in addition to regular pay. It is when they pay you extra for performing extra in addition to the regular pay that they pay you. For example, if they pay for your overtime, it is additional remuneration given to efficient workers for their meritorious performance in terms of time, costs, and quality to motivate them to be more productive. So they are motivating you to be more productive to the organization by paying you extra compared to the regular wages. Then the basic forms of incentives, it's when they give you bonuses. The first is bonuses. A bonus is an incentive payment given to an employee beyond his normal standard wages. It is normally given at the end of the year and it's part of the base pay. So it's when they give you a bonus, they appreciate you by giving you a bonus for being more productive to the organization. Then another form of incentive is merit pay, a reward based on how well an employee has done the assigned job. The higher the performance, the greater will be the reward. So it's when they pay you according to how well you've performed the job or a particular task that they assigned you. That is merit pay. Another one is commission. Commission is paid on the basis of sales made by the employee through different plans. So if you make more sales, you get more commission. Yeah, there is merit pay, reward, and then merit pay, commission, and bonuses. Then we have the categories of incentive plans. The three categories of incentive plans we have individual incentive plans, it is time-based and output-based plans. Then organization-wide plans where we have profit sharing, co-partnership, gain sharing, and lastly we have group plans, which is output-based. So those are the three categories of incentive plans. Let's look at each of them. The first one is in video planned incentives. In video planned incentives, we have time-based incentive plans. Our wage rate is determined and incentives are paid on the basis of time saved. So here they pay you according to the time that you've saved at work. For example, if you were supposed to do a particular task in 10 hours and you complete that task within 2 hours, they pay you for the time that is saved. Yeah, this can be paid using Halsey plan, Rowan plan, and Emerson plan and Baduex plan. Those who do cost accounting, labor accounting. Yeah, there is house plan, Rowan plan. So they pay you according to the time that you've saved at work. That is time-based incentive plans. Then we have output-based incentive plan. Our wage rate is determined and incentives are paid on the basis of output produced. So they pay you according to the output produced. The more output in standard time or the standard output in less time. When you are supposed to produce 1,000 units in 1 hour and you decide to produce 2,000 units in 1 hour, 2,000 units in 1 hour, they will pay you for the more output that you produced. So that is output based incentive plan. Yeah, so under individual plan incentives, we have time based. They pay you according to time saved at work. Then output incentive plan, they pay you on the basis of more output that you produced. Then we have organization planned incentives. Organization planned incentives, here we have profit sharing. It is an arrangement by which employees receive, in addition to their wages, a share. It's fixed in advance in profit of the enterprise. So profit sharing, it's a method of industrial remuneration under which an employer undertakes to pay the employee a share in the net profit of the enterprise in addition to regular wages. So here, when the company makes profit, they can decide to share with its employees. So when it makes more profits, they call you another money that is not part of your wage. That is profit sharing arrangement. So it's also an incentive, organization plan incentive. Then there is co-partnership. It is an extension of profit sharing where workers share in company profits. Is based in the form of share by which they became entitled to participate in decision-making process. Co-partnership. So here, the company shares profits with its workers, but basing on how you came to work in the organization. For example, if you're a shareholder, your share of profits will not be like the share of profits of other employees. Yeah, so those are organization-based incentives, profit sharing, then co-partnership. And there is also gain sharing. Gain sharing, this method compares standards. It compares standard performance with actual performance during a given period of time. When actual performance exceeds standard performance, savings are shared with the employees. This method aims at increasing productivity, decreasing labor costs, and sharing the result gained with the employee. So here, gain sharing, it's when the company compares its standard performance, how they're supposed to perform, and how they actually performed. So if their actual performance exceeds the standard performance, it means that they gained as a company. Yeah, and those gains will be shared with, like, amongst them, amongst all the workers, all the stakeholders in the what? In the organization. Then we have employee stock option plans, ESOPs. Under this plan, employees are allotted company share below the market price. Like you sell shares to employees but at a lower price compared to the way you sell shares to the people that are outside the organization. That is employee stock option plans. Yeah. Employees are allocated company shares below the market price. The term stock option implies the right of an eligible employee to purchase a certain amount of stock in future at an agreed price. So you pay the employees, you allow employees to buy shares in the organization at a lower market price. So those are the organization-based incentives or organization planned incentives. Employee stock option plans. There is gain sharing, there is profit sharing, and co-partnership. Thanks for watching.